Enron's accountants destroyed over 1 million documents in a single week while federal investigators were already knocking on the door. They shredded them anyway, and for a moment, it almost worked. $61 billion evaporated, 20,000 jobs gone, the largest corporate bankruptcy in American history. And the answer to how it happened is something far more disturbing than theft. How does a company worth $80 billion disappear in 18 months? That question will change how you read every financial headline for the rest of your life. But the answer isn't in the collapse. It's in something that happened years earlier, in a decision that seemed not just reasonable, but brilliant. 1985, Houston, Texas, two natural gas pipeline companies merged. Nobody noticed. They called it Enron. Kenneth Lay became chairman, PhD economist, politically connected, relentlessly ambitious. He understood one thing most executives never learn, that credibility is worth more than product. But Lay alone couldn't build what Enron became. He needed someone who didn't just want to be rich, someone who wanted to be legendary. In 1990, he found him. Jeffrey Skilling arrived from McKinsey and Company. He had one idea: stop thinking like a pipeline company, start thinking like a bank, turn natural gas into a financial instrument, make Enron a market maker for energy itself. The board said yes. By 2000, Enron was posting revenues of $111 billion annually. Fortune magazine named it America's most innovative company. 6 years in a row, a woman named Barbara Roper had worked her entire career to save for retirement. Her financial advisor told her Enron was the safest investment she could make. She put everything in. 30 years of savings. She was not alone. 20,000 employees did the same thing because every signal they received said this company was invincible. Pension funds poured money in. Analysts on Wall Street called it a buy, always a buy. But here's the detail that none of those analysts ever explained clearly. Nobody could say exactly how Enron made its money, not in plain language, not in a way that made sense. And the reason nobody pushed harder on that question is the most important thing this story reveals. What one man was quietly building inside Enron's finance division would eventually make that question unanswerable by design. The first crack was buried in the accounting. Enron used something called mark-to-market accounting. The idea was straightforward. When Enron signed a long-term contract, it booked all projected future profits immediately, today, the moment ink hit paper, not when the money arrived, not when the service was delivered. The SEC approved this method for Enron in 1992. The Financial Times later noted that this created a structural incentive: sign the largest contracts possible, project the most optimistic returns possible, book them immediately, report record profits, then sign more, book more, repeat. Revenue was soaring, cash flow was not. A junior analyst named John Olson at Merrill Lynch raised concerns about this gap as early as 1998. According to reporting by Bethany McLean in Fortune magazine, Olson was eventually pressured out. Merrill Lynch lost Enron's investment banking business over the issue. Court documents would later show Merrill Lynch participated in transactions that helped Enron disguise debt. That detail matters because it tells you exactly who was watching and what they chose to do. Meanwhile, inside Enron's finance division, Chief Financial Officer Andrew Fastow was building something extraordinary. Fastow created hundreds of off-balance sheet entities, shell companies with names like LJM Cayman and Raptor. These entities had one purpose: to hide Enron's debt. Enron would sell underperforming assets to these shells. The shells absorbed the losses. Enron's books stayed clean. Enron's stock stayed high. And here is the detail that should make your jaw drop. Fastow personally profited from these entities. According to prosecutors, he extracted over $30 million from shell companies he created to serve his own employer. He was on both sides of every transaction, the company's CFO approving deals that paid himself. Court documents revealed he named several entities after his own children, his son's initials, his family's nicknames. He built a financial labyrinth and used his own family as wallpaper. The auditors at Arthur Andersen signed off on all of it, year after year, clean audit, no concerns. Sharon Watkins was a vice president inside Enron. On an evening in August 2001, she sat alone at her desk. She knew what she was about to do could cost her everything: her job, her career, her reputation inside the company she had worked for years. She wrote anyway. She wrote that she was incredibly nervous that Enron would implode in a wave of accounting scandals. She named the specific partnerships, named the specific risks. She printed the memo. She walked into Kenneth Lay's office and handed it to him directly. Lay read the memo. He commissioned a legal review. And what Kenneth Lay did next sealed the fate of every single person who worked for him. The review was conducted by Vincent and Elkins, Enron's own outside law firm, the same firm that had helped structure many of the partnerships now under scrutiny. The review found no significant issues. August 2001. Jeffrey Skilling resigned as CEO after only 6 months. His stated reason was personal. He had sold nearly $200 million worth of Enron stock in the preceding year while telling investors publicly to buy. Employee retirement accounts were frozen during the same period, a trading blackout. Ostensibly administrative, executives faced no such restriction. They watched on screens as their retirement savings began to fall. Markets noticed the resignation. The stock began dropping, slowly, then faster. October 16th, Enron announced a $1,028 million charge against earnings from assets that had previously been reported as profitable. Wall Street analysts asked questions. CFO Andrew Fastow refused to explain the LJM partnerships on the earnings call. He said they were too complex to describe publicly. On October 22nd, the SEC opened a formal investigation. What happened next happened fast, breathtakingly fast. Credit agencies downgraded Enron's debt. Banks called in loans. Trading partners stopped trusting Enron's contracts. The lifeblood of a trading company is counterparty confidence. When that evaporated, everything evaporated with it. November 8th, Enron restated 5 years of earnings, 5 years of financial results, revised. According to SEC filings, $600 million in reported profits reclassified as losses. November 9th, Dynegy agreed to acquire Enron, a lifeline. November 28th, Dynegy walked away. December 2nd, 2001. Enron filed for Chapter 11 bankruptcy. $61 billion gone. 20,000 employees lost their jobs that week. Many lost their retirement savings the same day. Barbara Roper was one of them. She testified before the United States Senate in 2002. She was 62 years old. She told senators she had done everything right, saved every year, trusted the company, trusted the advisors who told her Enron was safe. She said she had nothing left. Not a dollar, not a plan, nothing. She was one of thousands who said the same thing. Linda Lay, Kenneth Lay's wife, appeared on the Today Show that same week. She said the family had lost everything too. She said they were fighting for survival. The Lay family owned multiple properties, including a 17,000 square foot condominium complex in Houston. The human math was not comparable, but what prosecutors were assembling, what they were about to discover, was something that reframes everything you've just heard. Here's what the public didn't fully understand in December 2001. The fraud at Enron wasn't just Fasto's shell companies. It wasn't just mark-to-market accounting abuse. Enron had also been manipulating the California energy market for years. Internal memos with names like Death Star and Get Shorty detailed specific trading strategies to create artificial energy shortages. Deliberate, systematic, documented in writing. Those shortages caused rolling blackouts across California. They contributed to the political destruction of Governor Gray Davis. They cost California consumers an estimated $30 to $45 billion, according to the Federal Energy Regulatory Commission. Enron wasn't just lying about its own books. It was engineering crises in the real world and profiting from the suffering. Everything you thought you understood about Enron being an accounting scandal was only half the story. Arthur Andersen had audited Enron for 16 years. It earned approximately $52 million a year from Enron, $25 million in audit fees, $27 million in consulting from the same client simultaneously. According to court documents, Arthur Andersen partner David Duncan directed the shredding of audit documents after learning of the SEC inquiry on October 23, 2001. 1 million pages destroyed. Within days, with investigators already watching, Arthur Andersen was convicted of obstruction of justice in June 2002. The verdict destroyed the firm immediately 85,000 employees worldwide lost their jobs, not because they committed fraud, because their employer helped cover it up. Andrew Fasto pleaded guilty in 2004. He cooperated with prosecutors. He served 6 years. He surrendered $45 million. Jeffrey Skilling was convicted in 2006 on 19 counts, sentenced to 24 years after legal battles and resentencing. Released in February 2019, he has since attempted to launch a new energy company. Kenneth Lay was convicted on 6 counts of fraud and conspiracy in May 2006. He died of heart disease on July 5th, 2006, 6 weeks after conviction. Before sentencing under a legal doctrine called abatement ab initio, his conviction was vacated. Kenneth Lay, the man who ran the company while employees watched their retirement savings hit zero, died with a clean criminal record. He never spent a single day in prison. Sharon Watkins, the woman who handed him the memo in August 2001, never received formal whistleblower protections. Her story helped pass the Sarbanes-Oxley Act of 2002. The law bears the names of 2 senators, not hers. And here is the final fact, the one that closes the loop on everything you've just heard. Arthur Andersen's conviction was overturned by the United States Supreme Court in 2005. Unanimous, 9-0. The firm was already gone. 85,000 jobs erased for a conviction that the highest court in the country later threw out entirely. Here is the uncomfortable truth that no official report will ever quite say directly. Enron didn't invent fraud. Fraud is as old as commerce. What Enron invented was a system for making fraud look like innovation. It used complexity as a weapon. When something is complicated enough, nobody admits they don't understand it. Analysts won't, regulators won't, board members won't, especially when the stock keeps going up, especially when the company donates to campaigns, when its executives are friends with the president. Jeffrey Skilling genuinely believed that what he was building was real. Court testimony revealed a man convinced of his own brilliance, convinced that the future profits were real, that the contracts would deliver, that the numbers would eventually catch up. That is what makes Enron truly terrifying. Not a simple theft, not a simple lie, a delusion scaled to $80 billion, maintained by thousands of intelligent people, validated by prestigious institutions, celebrated by a financial press that never asked the right question until it was too late. Bethany McLean of Fortune magazine asked the right question in February 2001. Her article was titled, "Is Enron overpriced?" She asked how exactly Enron made its money. The company flew executives to New York to pressure her editors, called her unethical, said she didn't understand the business. 9 months later, the company was bankrupt. The answer to that question, how does a company worth $80 billion disappear in 18 months? Is this: it was never worth $80 billion, not for a single day. It was worth whatever enough people believed it was worth, for long enough, with enough complexity to prevent the question from being asked. That is the invention Enron gave to modern capitalism, not the fraud itself, the permission to believe the story instead of reading the numbers. And according to SEC filings and court documents, every mechanism Enron used has been used again since. Special purpose entities, off-balance sheet debt, mark-to-market abuse, the names change, the architecture stays the same. Here is the question for the comments today. Kenneth Lay died with a clean criminal record. Sharon Watkins never received formal whistleblower protections. Arthur Andersen was destroyed by a conviction the Supreme Court later overturned. Was this justice or the system protecting itself? Yes or no? Leave it below. Corporate power leaves a trail. Sometimes that trail leads to a courtroom. Sometimes it leads to a penthouse. The difference between those two outcomes is the story this channel exists to tell.